How do I know how much credit my family can afford? Determining how much credit your family can afford is based upon your household income and your family's needs. The best way to estimate the amount of credit you and your family can afford is to build a budget that details your sources of income, spending habits, and savings ability within your household. It also helps to create a spending plan so you can see on paper exactly how much money is being spent, as well as how much money you may or may not have left over at the end of the month. By using both a spending plan and a household budget, it's easy to see exactly whether or not you're earning enough income to cover your regular living expenses. If you're not covering the basic costs of living, such as groceries, gasoline, heat, and electricity, it's not a good idea to use credit for purchases. Without the money to pay off your credit card charges, you'll quickly incur finance charges, and soon your interest fees will outweigh the original cost of the item that you financed. A good example of this is if you decide to buy a large television with your credit card and pay off the bill later. With a credit card that carries an 18% APR, it will take you 8 full years to complete a $500 purchase by paying only the minimum payments. After the 8 years are through and you've sent your final payment, you will have paid $439 in interest charges alone, making the real cost of the TV $939. As a general rule of thumb, experts advise that credit card debt should constitute no more than 10% of a family's total income. For many families, specifically those who are not meeting the basic cost of living, that 10% is still too high. While purchasing items on credit can seem like a short-term solution for basic needs, the cost in the long run might put you deeper into debt. Why is my credit report important? A credit report is a document that's compiled by each of the 3 credit bureaus detailing your personal credit activity. The 3 credit bureaus are Experian, Equifax, and TransUnion. Your creditors or credit card companies report your payment behavior to the credit bureaus to provide a central document that tells just how much of a risk you are. Each credit bureau then reports on your credit worthiness, and the reports may vary depending upon the creditor's reporting behavior. This is a sample credit report. Knowing how to read your credit report can be a useful skill to have, especially if a problem should arise in the future. Included in your credit report are the following items. 1. Your personal identification information, such as your name and social security number. 2. A listing of your existing and past credit accounts and their balances, such as your credit cards, accounts that have been sent to collections, including cell phones, college or car loans, and child support. 3. Inquiries, which are a listing of all the companies or creditors who've accessed your credit report over the past 2 years, including housing agencies, landlords, potential employers, and insurance companies. 4. Any information of public record, such as bankruptcy information, tax liens, or foreclosures. And finally, a consumer statement that you can include as a brief description of your own credit behavior, summed up in 100 words or less. Your credit score is a number ranging from 300 to 800 that represents your level of risk to creditors. Generally, a score of 700 or higher is considered good to excellent credit. While your ultimate goal should be to attain close to an 800 score, recognize that no one truly achieves a perfect credit rating, because accepting or paying by credit is always a risk. A person who scores a 750 credit rating most likely pays off each of his or her balances in full every month or pay period and is never late with a payment. He or she also avoids applying for every credit card offer available simply to get the free towel, hat, or 10% off at the department store. Remember, every time a creditor pulls your credit report in order to qualify you for credit, a hard inquiry is made and it appears on your credit report. Too many hard inquiries, in fact, can negatively affect your credit score. It's also important to prove to creditors that you have the means of paying your bills by maintaining a steady income. In many cases, young adults do not have a very high credit score, not because of bad credit history, but more so because they don't have much of a history at all. A young adult may have just started a job, may only have 1 credit card and no real assets of their own. In that situation, a loan officer might see that person as a higher risk than someone who has consistently paid a mortgage on a house for 20 years. If you find yourself in a situation where you have an insufficient credit file, all hope is not lost, and credit can still be established. The most important thing you can do to begin building credit is to create a relationship with banks. This concludes the Financial Fitness Center's web seminar on Building Better Credit, brought to you by American Consumer Credit Counseling. For more information about this topic, or to order a free copy of the FTC's Building a Better Credit Report brochure, please call 800-769-3571, extension 708. Also be sure to check the Financial Fitness Center's additional free web seminars on budgeting, home buying, and preventing identity theft for further financial education.